All right, let's get right into it. Welcome to the ultimate cheat code for your LECPA final boss, taxation. If you're an accountancy student staring down the barrel of the board exams, you already know that preferential taxation is one of those topics that can instantly drain your energy. But seriously, don't sweat it. This explainer is designed specifically for how your brain actually works. We're going to lock the rules for registered business enterprises and renewable energy into your long-term memory for the next 3 years, so you are totally ready when exam day comes. Let's do this.
Here's your roadmap for this explainer. First, IPAs and RBEs defined. Then, core incentives, ITH, SCIT, and EDR. The irrevocable choice rule, VAT and local tax rules. Renewable energy perks, and we'll wrap up with the LECPA Ultimate Bullet Review.
All right, Level 1, IPAs and RBEs defined.
So let's start by identifying the critical NPCs that actually grant you these tax power-ups, the investment promotion agencies. Think of IPAs as the ultimate government gatekeepers. You absolutely must register your enterprise with them to unlock any special tax perks. If a company isn't registered, well, they're just playing the standard game and paying regular corporate income tax.
You gotta memorize these acronyms: BOI, PZA, CDC, and AFA. Spotting them on a board exam question is your first major trigger warning that preferential tax rules apply. When you're reading a problem and see PEZA registered, your brain needs to instantly switch over to the rules we're about to cover.
Moving on to Level 2, Core Incentives, featuring ITH, SCIT, and EDR.
Let's break down the 3 core power-ups available to registered business enterprises. Take a mental screenshot of this matrix right now. It is your anchor. The income tax holiday, or ITH, serves as your base invincibility. That's a full exemption on income from registered activities for 4 to 7 years. After that runs out, the enterprise transitions to either the SIT or the EDR for the next 10 to 27 years, depending on who grants it and what type of enterprise they actually are.
Okay, burn this number into your brain. The Special Corporate Income Tax, or SCIT, is exactly 5% on gross income earned, which is in lieu of all national and local taxes. And here is the ultimate examiner trap, so pay close attention. That 5% SCIT is only available to registered export enterprises. A domestic market enterprise, or DME, can literally never avail of the SCIT. So if a question asks for the SCIT of a domestic market enterprise, boom, you know it's a trick.
Now, if an enterprise doesn't take the 5% CIT, they might use the Enhanced Deduction Regime, or EDR. This is awesome because it allows them to deduct way more than they actually spend. Here is your study hack to group these mentally. Think of intellectual investments, like training and R&D, getting a massive 100% additional deduction. Physical inputs, like domestic raw materials and direct labor, usually get a 50% additional deduction. Power gets either 50% or 100%. Grouping them like this makes it so much easier to recall under pressure on exam day.
Level 3, the irrevocable choice rule.
Let's tackle a super common trap examiners use to test your understanding of incentive flexibility. So if a company equips the SIT power-up, can they swap it for the EDR mid-game if their operating expenses suddenly shoot up and they decide they want more deductions?
The answer is a hard no. No way. The law is incredibly strict on this. Once an RBE chooses its incentive package, whether that's the 5% SCIT or the enhanced deductions, that choice is completely irrevocable for the entire duration of the entitlement period. There are absolutely no takebacks in preferential taxation.
Because the choice is irrevocable, this hard-coded rule naturally follows. There is absolutely no simultaneous availment allowed. You cannot claim the 5% SCIT on gross income earned while simultaneously claiming the massive enhanced deductions of the EDR. You gotta pick one path and stick to it.
Let's hit Level 4, VAT and local tax rules.
Next, we navigate the treacherous waters of VAT and local taxes. Examiner trap alert right here. The original CREATE Act had a very strict requirement for VAT 0 rating on local purchases and VAT exemptions on imports. The goods had to be directly and exclusively used in the registered project. But the Create More Act loosened this up. Now it just needs to be directly attributable to the registered project. If you see exclusively used as a strict requirement on a modern exam question, it's probably testing your knowledge of this specific amendment. Shifting to local taxes, 2% is the absolute maximum ceiling a local government unit, or LGU, can charge for the RBE local tax on gross income.
This applies during the ITH and EDR periods, and it's in lieu of all other local taxes, fees, and charges. But remember, this doesn't apply if the enterprise is under the 5% SCIT. Why? Because that 5% already includes a 2% share for the LGU.
But wait, what if an economic zone is so massive that it overlaps multiple LGUs? How do they share that 2% local tax? The rule is actually really simple. They split it evenly based on two metrics. 50% of the revenue is apportioned based on the population of the LGUs, and the other 50% is apportioned based on their land area.
Welcome to Level 5, Renewable Energy Perks.
Because the government really wants to promote green energy, renewable energy developers get some ridiculously massive buffs. They get a full decade, that's 10 years, of duty-free importations on capital equipment. For real estate, they enjoy a drastically reduced 1.5% special real property tax rate on equipment and machinery. And for local purchases needed to build their plant, 0% VAT.
Now, here is a golden nugget for your exam prep. Carbon credits. If you see the words carbon credits anywhere on your exam paper, instantly associate it with being completely tax-exempt. The proceeds from selling these emission credits are not subject to income tax, not subject to VAT, not subject to anything at all. It is a 100% exemption.
But to actually unlock these green power-ups, an RE developer has to follow the exact right sequence. They can't just skip straight to the BOI. Step 1, they must register and get accredited by the Department of Energy, or DOE, first. Only after that can they proceed to Step 2, which is registering with the Board of Investments. The sequence absolutely matters.
And finally, Level 6, the LACPA Ultimate Bullet Review.
All right, boss battle time. Let's lock all this data into your long-term memory with a rapid-fire space repetition review. Listen closely and answer the prompts in your head as we go. You need to recall these core rules instantly. The income tax holiday is your baseline, lasting 4 to 7 years. The special corporate income tax is 5% on gross income earned, and it's strictly for export enterprises. No domestic enterprises allowed. And once you choose between SCIT and the Enhanced Deduction Regime, your choice is final and irrevocable. You absolutely cannot have both.
Round 2 of the review. For VAT, don't fall for that old exclusive use wording. The Create More standard is now directly attributable. The local tax cap during ITH and EDR is exactly 2%. Renewable energy developers get a super sweet 1.5% real property tax rate. And what happens when you sell carbon credits? Yep, you guessed it, completely tax-free.
You've got the cheat codes now. The secret to that 3-year retention isn't just reading your textbook over and over. It's all about structure. Keep reviewing this specific mental map of IPAs, core incentives, and RE rules whenever you study. Trust how your brain groups this information, stay focused, and you are going to absolutely dominate the taxation board exam. See you on the next explainer.